Okay, this is Ed Meisekland. I'd like to welcome all of you to today's first in a series uh, of planning the eventual sale of a company. And so what we'd like to do is share a couple things that we've learned over the 40 years that we've been in business. Now, a couple housekeeping items. The first thing is that if you have questions, Chelsea from our office will be manning the chat. So just submit any questions as we go along. We are recording, so we're planning on a hard stop in approximately 30 minutes. So if for whatever reason we don't get to the questions that you submit, I will make sure that all of the questions are answered as part of the recording that gets forwarded later. Okay, so let's go ahead and begin. So today what we're going to cover is we're going to cover background on planning, the state evaluations, and an exit planning overview. So what's today's market? So first things first is that most people, and again, 2/3 of people are not familiar with all exit options. In a one of the upcoming webinars that we do, we're going to talk about transfer methods, um, because there are a variety of transfer methods. And what I mean by that is that all the way from liquidation. So you have an auction all the way to third-party sales, and there's various transfer options that you probably don't know about. When we work with our clients, a lot of people are unaware that they could sell to a variety of different types of people. Next is that, and you can read this, that 78% of business owners have no formal transition team, meaning that they go into the process and kind of build as they go. There's no 83% don't have a transfer plan, and nearly 1 out of every 2 business owners don't have a plan at all. And what we want to convey is that our experience in working with business owners, we can tell you that the industry average is between 20 and 30% of companies sell. We have empirical data just by virtue of the work that we've done that about 87% of companies that do this pre-sale planning work will sell because they understand their value. One of the other things is that we, as business owners, only 7% have a life after business plan. And what that means is the most business owners need something to retire to or to go to. And what we're finding is that we don't have, or most business owners do not have, a plan. And I wrote an article earlier last year that about business owners and the aging. Everybody talks about baby boomers, and what we're seeing is that as long as the business owner is healthy, capable, competent, and able to continue to serve in the function that they're serving in the business, why retire? Because they don't understand what, they don't have anything to retire to. And so, God bless them that they are able to do that. And we want to, um, you know, uh, provide them with enough information that they understand that how they can do that and define what it is that they're going to go to afterwards. Again, 40% don't have a contingency plan in place because life happens. And too often that we are faced with, my dad is sick and needs to sell the business. My mom and dad are getting a divorce. We need to sell the business. And it shows, it comes here. And the problem is that we don't have the opportunity to help identify and mitigate the risk of going into the sale process. Okay. And then lastly, most companies don't do formal business valuations. It's funny that when they come into our shop, everybody thinks that they know what their business is worth, and there's no empirical evidence to support it. It's more, I want this. So formal valuations, or at least value analysis, is helpful in the process. Okay. So what we exit plan, and everybody thinks that exit planning is, I need to sell my business. No, exit planning is a process that if you begin, you can formulate a strategy to be able to sell or be able to transition, whether that be internally or externally. Internally meaning to employees or family members, externally meaning to third-party buyers. So all we want to do is to put you into a position that you go through a process understanding what creates value and understand how it's going to transfer when you want to and how it's going to. Okay, so why should a business owner have an exit plan? One, um, because it maximizes the value of the business. You, through going through the pre-sale planning process, you understand that the value of the business and what buyers are looking for. Okay, so when we're working with our clients, what they see is these are the risks that a buyer is going to experience if they acquire the company. So when we're able to mitigate the risk, we put the company into a far better position to maximize the positive attributes and minimize the negative. So that's how the first thing we do is assess the company. The second thing on why owners should have a plan is because it prepares them personally and financially. In our process, I mean, we come alongside of the other advisors, including financial planners, accountants, attorneys, tax planners, estate planners, insurance folks. We come alongside so that the business owner is financially prepared. They understand what the ramifications are if and when they sell. And then, like I alluded to earlier, the business owner has to be prepared personally. And what does that mean? And the next two, um, you know, I guess the way we choose to look at it is that there is an emotional component to this whole process. Most business owners are really emotionally tied to their business, and their identity is wrapped up in it. And to look past, this business that has been such a big part of their life, you have to be ready personally. And then lastly, what are you going to go do? We find a lot of business owners that move into philanthropy. They some retire to beaches, but whatever the case is, everybody has to be on board on what this third act looks like. And that third act could be, like I said, anything that that the business owner chooses, but they have to remember, we're talking probably 20, 30 years of someone's life. Okay. So exit readiness, like I said before, it's not the decision to sell. This is just putting you into a position that you can sell should you wish, how you wish, and for the price you wish. And so, like I said, it's a state of mind. And then lastly, when we look at the two considerations, is the owner ready and is the business ready? And one of the things that we experience and that we work with business owners a lot on, the values are X's and O's. I mean, we have empirical data to support positions on here's what companies are selling for and here's why. The emotional component, that's the something that needs to be considered, because most deals, when they fall apart, 20% fall apart because of a variety of reasons. Just different things happen in deals. 40% fail because of value gaps. And then lastly, the other 40% are emotional. So I just can't sell my company, or it's just not the right buyer, or it's just not the right time. They get into the process and they recognize, like, oh, I didn't know it was going to be like this. Or I start looking at that third act that I keep alluding to. They're like, I can't do that. So we want to facilitate those discussions so business owners understand what they're getting into. Okay, so exit readiness. These are the requirements. So you need to have a clear understanding of what your personal, business, and financial goals are. Okay, and the reason we we talk so much about this is because what normally happens is business owners will go to their financial planner and say, I'm looking at retiring. And the financial planner will say, okay, well, you need X number of dollars a month to maintain this level of lifestyle. So immediately what happens, they come to us and they say, this is how much I want to retire. And then we back into evaluation. Unfortunately, there's no correlation to what is needed to retire versus the business value itself. And that's what that third part is. Is the business itself ready to be sold? Okay, so assessing transition readiness. All right, there's three areas. You got discover, prepare, and decide. In the discover phase, we talk about business valuation, and we have one of our, not this series, but I believe not this upcoming webinar, but the following one, we do a deep dive into valuation so you can understand what it takes to do a business valuation and the different types. So we either do a formal business valuation, or we do what's called an EVA, and that's an enterprise value analysis. They both arrive at the same thing. The business valuation can be scrutinized. And when I say scrutinized by independent third parties. So if it was being reviewed by the IRS for gift purposes, if it was being reviewed by lenders, private equity, those kinds of things, where those people need to understand all of the assumptions made to arrive at that business valuation or that value. That's when we do business valuations, formal valuations like that. The assessments, or the enterprise value assessments that we do, most business owners, I can tell you 80% of the time, we're doing these enterprise valuations, because what happens is they come to us and they say, look, I understand my business. I just need to know a number, and I need to know why. And our shop is a little bit different, because not only do we provide a report, but we also provide a presentation that's an interactive presentation with our clients, so they understand and they can question as we go along why the company is worth what it is. And why did I make the assumptions? And although it's one thing to read it, it's another thing to have a conversation over it. I certainly can communicate a heck of a lot better in person than I can writing. Okay, so by understanding your value, you now have a prioritized action plan. And what that means is that you understand what creates value in your company. So we can talk about customer concentration issues. We can talk about employee concentration issues, key people. Where do you fit in the equation? So like any other goal setting type environment, the prioritized action plan is just that. What's most important? What's going to make the biggest impact for value? Okay, so then we move into prepare. Okay, so again, we talk about, you have the value. We now know about whether or not, or I shouldn't say whether or not, but you now have a plan on what you want to do regarding to fix the company. We're then collectively going to the other advisors that will be counseling you as business owners. So we talk about personal and financial planning. What needs to happen if you sell your company for $1 million? Is that enough? What has to happen in order to make those numbers work for the next 20 years? So we get that becomes that number. That's what we start working with. And then we start talking about business improvements. Where are we going to focus on to make the biggest impact? So as part of the preparation, and this is one of the challenges that we run into in our world, it's called the mantra is time kills all deals. And assemble due diligence materials, that's what the DD stands for. Assembling due diligence materials, having that information, having all of your books and records in the position that should an unsolicited offer or something happens where we have to address the disposition of the company, we're in a position that everything's where it needs to be, rather than fumbling trying to find all of these things that a buyer or an independent third party is going to want. So we help facilitate where is all of the things that are needed in order to keep the deal moving forward. Last is preparing a book, and what we call it is, there's a variety of different names: prospectus, confidential business review, confidential information memorandum. All it is it is a book that has enough information about your company that in the event that someone showed up at your doorstep, you could hand them, and it answers 80% of any normal buyer's questions. Okay, so that's the preparation. Then you have to decide, what do you want to do? And you can see the key milestones are right between the valuation and the prepare, and then decide. So we can go, do you grow or do you exit? And either work. I can tell you that from my experience, when we work with business owners, they come in, we do this value assessment, and they sit there and they go, and we tell them all these places that they can focus on to improve the value. And most of them are sitting there saying, you know what? Yeah, I don't want to do that. Let's go to the market. So a lot of people do that, but and I congratulate you that you're on this call educating yourself, because most people don't. And like I said, I'm thrilled to death that you're here. So when we look at decide, again, you just have to decide, is it now the right time for you? And again, it's a matter about controlling the process. Okay, so growing or exit. So when you can buy, how do you grow? You can buy other companies, you can improve processes, and you can grow. Now, when I say grow, a lot of business owners that we work with when we talk about growth, they immediately equate it to revenue. Revenue's great, and I don't want to minimize that. But what's better is fixing the engine. How do we improve the efficiencies? How do we improve cash flow? There's undoubtedly, in every business, there is all kinds of leakage. When I say leakage, that there are places that can be addressed to maximize cash flow. So when you want to grow, then we move into a sales type scenario where it's just add gas, and now we're just adding revenue to a machine that's working, and then we amplify the cash flow, which ultimately translates to greater value. And then, like I said, sell or succeed. Who is this going to? Is it going to an independent third party, or is it going internally to an heir or employees? So again, if you choose to fix, we move into value creation. That we start talking on a regular basis how to improve the efficiencies of the company, or we move into a transition program. So when should you start? Obviously, I'm pitching that you need to start now, and because it takes time. I mean, this whole process, and I alluded to it before, this whole process is about control. Okay, I want you to be in a position to control when, how, and for how much you want for your business. And that's ultimately, that puts you in an entirely different category. So by preparing, you now know what are your exit options. You understand your business and what creates value, so you can have a more meaningful interaction with an investment banker or someone like us. And then we want you to focus on your business, not focus on the peripheral, what all is going on. We want you to the best person that can talk about your business and understand your business. And again, this is about risk. I want to reinforce that when we're talking about risk, we your understanding of your business is what a buyer is looking for. So as the buyer, if you don't have an understanding of your own business, and a lot of business owners don't, they understand, this is the way we've done it for 100 years and that's just the way it's going to work. Well, do you understand? We had a client that had an employee that they were just unwilling to fire. I mean, the owner himself said, I should get rid of this guy. Well, this guy's making 80 grand a year. Well, you put a 4 multiple on that 80 grand. That's $320,000 that you're leaving on the table as a result of this guy. So at any rate, those are the kinds of things that we want you to be focusing on, not necessarily all of this other stuff. And again, like I said before, exit strategy is good business strategy. So these are the self-assessment. So do you know how much your company's worth? If you do, great. If you don't, that's your first place to start. Now you can go Google and always be sensitive to what you're looking at. A lot of the times when I'm working with business owners, they show up here and they say, yeah, I Googled and it's 4 times revenue. I'm like, yeah, I'm afraid, or 4 times earnings. And they're like, yeah, well, they're assuming that we're talking revenue as opposed to cash flow. So be sensitive to what you're Googling and how you're Googling and what are the sources that are providing it. To whom, this is another one, to whom are you thinking about? Who is the highest, the person that's going to pay the most is probably a third party. The business owners that we work with typically look through employees, heirs, those type of people that they want to support that have supported them throughout the years. So, and then lastly, what's your timeline? You need, I wrote this article about timing the market, and you can Google it. It's called Baby Boomer Business Owners May Consider Selling. And this is a follow-up from a Indianapolis Business Journal article from a few years back. I never advocate trying to time the market. It's like the stock market. You just can't do it. But I can tell you that what the purpose of the article that I wrote was that, and I said it at the beginning, as long as a business owner is relevant and capable and is doing meaningful work, then God bless them and keep doing it. But we're now starting to see business owners that are in their mid-70s and some that are in their late 70s. So things are going to have to change, and they're going to have to start moving to that exit, toward that exit. And so what I see, and what, we all know that there's bound to be a recession at some point. I don't know when, but I can tell you good businesses sell regardless of economic climate. I've been doing this for nearly 30 years and I've seen downturns. And again, it's the same thing. It insulates you from all of the other challenges that some underperforming companies have. So you just have to decide, what makes the most sense. Okay, so readiness correlates to value. Again, improving your adjusted cash flow does far better for you from a value standpoint than working on revenue. Because when we work on cash flow, so you essentially you get 2 bangs for a buck. You have the improving your cash flow, all right, as well as you're reducing your risk, which is tied to a multiple. So the higher the multiple, the less the risk. So by virtue of fixing the business, you improve the cash flow and the amount that you will get, you'll realize from the sale of the company. The readiness process, again, it adds to cash flow. Recognizing where the value is in your company will enable you to focus on that, so you make the greatest impact. And then lastly, everybody, I always get, what's going to happen? Okay, well, I can tell you that credit's good. It just is. People are making all kinds of loans to business buyers with the right resume, and 5% down. It seems that those deals are getting done. There's lots of private equity, and when I say private equity, there's groups out there that buy companies with the intent of fixing them and growing them and making platforms of them. I don't know the size of your company. It tends to be based for larger companies, but nevertheless, private equity is doing well. Taxes are in good shape right now. And then we're seeing that across most industries that company trends are doing well. Okay, so readiness issues. So first, we've got, how a buyer and seller look at the respective business. Okay, a buyer's looking at let me back up. As a seller, you're looking at the history, saying, you know what, this company has done X, Y, and Z. The buyer is buying on the future. Okay, you did X, Y, and Z. Now, how does this translate in the future? Where are the risks? So that's the valuation challenge. Credibility. All right. The credibility of financial information. I can't tell you how important this is. When we work with business owners, those people that show up with a yellow pad of paper saying this is and they have it with chicken scratch. That we can just tell them that no one's going to buy your company. Same thing, having professional financial statements or having your tax returns that can survive due diligence. Because what you need to understand is any buyer that's going to buy your company is going to essentially do a mini audit. They're going to verify all the things that you present on the tax return or financial statements. And so what we want to do is make sure that we can rely on this, because that will minimize risk and increase value. We also need you need to consider management and key employee retention. Now, you just need to identify it. I mean, there's different ways to structure transactions that mitigate that risk, but nevertheless, anytime you have a concentration, whether it be customers or you have key employees, you do need to we do need to plan for it. And lastly, seller issues. Again, it requires self-reflection. Do you want to why do you want to do what you're doing? Why do you want to sell your company? What are you going to do? Okay. Going into this process only to, and believe it or not, we've actually had clients say, yeah, this was kind of just a test drive to see, what the market was. Well, yeah, that didn't go well with us, and it certainly didn't go well with the buyer, and ultimately it didn't go well with the seller, because when the seller was ready, the market had changed, and unfortunately his company went unsold. Okay, benefits. Good business practice. It just is. Understanding your company is absolutely a great practice. Non-solicited offers show up. I can't. At least 2 or 3 times a month, someone calls and says, I have an offer. Can you help me understand this value? Is it a good number? It serves as a contingency plan, because life happens. Divorce, health, disruption, all kinds of things happen. So having a plan in place to understand what you're going to do with the business is important. So lastly, it increases value and it increases annual income and value. Okay, I have some questions from the chat. So what is the easiest and most profitable way to exit out of a business? Well, the most profitable way to exit out of a business is probably third party. Third parties tend to pay the most, because because if you think of the market, there's more buyers there's more of a pool of buyers to choose from, and as a result of supply and demand, it increases the price. So I would say that it, none. I shouldn't say none of these are easiest. There, it's yeah. None of these. I mean, I shouldn't say they're the process is the same. So again, I'll stick with the third party. So how to sell to your sons over time. It's funny you mentioned that, because I'm writing an article about doing transferring and using there's various vehicles to sell to internal parties. You have seller financing, you can go to conventional financing, but you can gift, and that probably requires some advanced planning. If you need that level of planning, let me know. I'll get you. I have a couple of attorneys that we work with on a regular basis that can help you minimize those taxes, or take advantage of tax breaks by gifting to your son. Valuation, I told you we're going to do that on not in March. And then beginning exit planning approaches. I have a funny way to assess your business that is not going to cost a single dime to you, I don't think. So the easiest way to evaluate the infrastructure of your company is to go away from it. Simply take a week or two off and leave. Don't call, don't do anything. Just make sure somebody is writing down all of the problems, or better yet, just come back and have a facility-wide meeting and say what happened. You will find out where all of your problems are with the infrastructure right then, and chances are nothing's going to happen to the business. Okay, so next steps. Okay, we have a complimentary assessment that we'd like to share with you. It's called the Value Builder System, and this is a self-assessment. It takes 15 minutes to do. It's non-invasive, and it gets you thinking about all of the things that we're talking about. It is a great first step. Like I said, it's complimentary. We'll send you a report on your business, and it will help you establish where you are and how you may or may not want to address the business going forward. Look, and contact us. Either just email us. You can reach us on the socials. But what I want to convey to you is, look, we've been doing this for nearly 40 years. We have an open shop. We have always, we'll let you know when we have to turn the meter on. Having exploratory conversations on how we might help or things that we might share. Happy to do it. If you go to our website, we have some exit checklists, some various different tools that you can download that will certainly educate you on this. And then lastly, our February 21st is our next seminar. We're going to talk about the process of selling a company. So with that, it looks like there's no more questions. We're going to conclude it for today. So again, on behalf of our organization, we're certainly glad that you joined us, and send your questions if we can be of any further assistance. Thank you so much.